We are live on Oz Property Investor. We bring the big names and we have the big fun for the last time of 2023. How you going, Jerry?
Wow.
What's happening?
Very well. You and I off air were having a crack at that, Joe. I was giving the best imitation I could, and I think I got into
Horrendous.
3 words and forgot what I was saying.
Love it.
Good.
All that energy. That's what we need. That is what we need. We got one session. This is the last session, Jeremy, and I know you're going to bring the bangers. So I'm excited about this.
Joe,
Jeff,
what are you excited about, mate? Come on. Hey, how you going?
Yes, that's what we do. We ask, how are you, Jeremy? How are you?
I'm well, guys. Thank you very much. And just for everyone out there listening, as a reminder, I was number 2 or number 3 in the Oz Property Group subscriber list. The invitation from Jeff. So I've been following you guys and following the whole group since the very start. And congratulations to having over 60,000 members, probably making you now the largest property group in all of Australia. Well done.
It's very strange to hear, isn't it? It's very weird that we are. I believe we are, as far as I can tell. If anyone can please dispute that and find if there is a larger property investment group that they are a part of, I'd love to know, because I think we are the largest. So I'll take it. But
give us
it's
a
only
nice rating on Spotify, people. I feel.
Yeah, someone. A couple of people have gone on our Spotify and just destroyed our rating. We have like 7 reviews, and 2 of them are just abysmal. And it's ruined our ranking. But the only reason we've gotten to this stage, Jeremy, is people like you sharing wisdom. You are an absolute legend in the property space. So I'm excited to unpack. What are we going to talk through? What are we going to talk through tonight is what's in store for 2024. Is that what we named it, Jeff?
We did. You came up with the name there, Joe. But I think it's about more than just that. I mean, that's a catchy title, and it's all about these predictions and all that sort of stuff, which is great. However, I think along the way there's gonna be those sort of timeless classics that people can take away and look to apply for their investing beyond 2024, beyond the next hotspot, because that's ultimately what's going to get you. The hotspot will sort of turbocharge if you can sort of get fortunate and pick some of that sort of stuff from some of the people we've had on this year. But I think that's what I'm excited about, to share that sort of longer term strategic sort of acceleration of property and wealth. So yeah, that's what we're going to be talking to tonight.
I'll take 2 of those, please. Take 2 of those.
Content of the week, Joe. Should we do it?
What's your content of the week, mate?
So I was listening to a podcast with Lewis Howes and Joe Dispenza, and I feel like I'm picking Lewis Howes because I've listened to it on taking the clothes in just before this, and I was like, you know what, this is interesting. Like, he was talking about abundance and about how our life frames are going to be expanded, or that they are sort of expanding 0.2 or 2.25 years every year from now. So our longevity is increasing, and he's sort of saying in about 10 to 15 years, he's saying that for every year, it's likely that they'll be able to increase our life expectancy by a year. And it was just like, wow, if we can actually do that, like, that's going to be insane. Like, and he's not going to say we're going to be immortal, because he's kind of saying you'd sort of start to see average life expectancies of sort of 120 to 130, 140 being more of the norm. So I just thought it was really interesting to share that podcast.
Do you want that though? Like, I don't know. I don't know. Like, when I'm 95, I don't know if I want another 30 years of being 95. I don't know. I don't know about that. But I'm all for it. Go for it. If we're lifting weights at 95, making it happen, living life to our fullest, I'm all for it. What's your content of the week, Jeremy?
I'm a big fan of Dave Ramsey, massive fan. So anyone listening, he's a bit of a finance guru. He's not afraid to tell it how it is. I love listening to his YouTube's quite late at night, and he gets to answer a lot of people's questions, people that ask normal questions that don't have the answers, and he gives them the answer straight away. But my content of the week is from him talking about unlocking the snowball effect. I think there's a lot of people that love that instant gratification, and they don't let things gravitate to be bigger and bigger and bigger over time. We want those fancy cars early. We want those nice holidays quite early. And if you let the snowball continue to grow, by the end of it, you look back and you say, wow, it's a monster. So to me, that I live my life that way. Everything I do, I start with little steps and say, what will it look like in 10 years?
Yeah, nice. So how would you describe it? The snowball effect, just little micro steps that build upon each other to give you that
Consistency.
compound. Yeah. Yeah. I think
Consistency.
consistently showing up. I think that is absolutely key to everything in life. Like you can't go to the gym one day a week and get absolutely wrecked and then not go for another 3 months. You've got to consistently go 3-4 times a week to be able to see any kind of results. And property, finance, money is exactly the same. You've got to show up consistently and making
Relationships
sure.
with everyone, yeah. You can't just expect to rock up with somebody you haven't spoken to for 5 years who's now a property mogul and say, "Oh, look, could you unpack all that? Like, where have you been the last 5 years?" Now that, yeah. But it's kind of reminds me of the Slight Edge or the 1% rule. One was by Jeff Olson, one was by Darren Hardy. Like those books talk all about the compound and just doing those small things day in, day out that are easy not to do. If you don't do them, you won't notice them for a day or next. But if you do them, you'll start to sort of build that momentum over time, which is just exciting and great. So great little share there, Jeremy. When's that podcast of yours with Toddy coming out? Can we share? Are we allowed to talk about that? Oh,
Yeah, I think it's getting edited at the moment, but it's
here we go.
It's what school should have taught you. That's the whole theme of it, and we really go through the basics. I think just the financial literacy, I believe, is lacking for many people. And I was lucky enough to have some really good people around in my life, and father who was very educated and accountant as well. So it's really giving people all those little lessons, these little 1%ers, which add up to something much larger. And we go through a lot of live phone calls as well. People calling up with their questions and we answer them. So very similar to almost like a Dave Ramsey style.
I was going to say, I'm like, this is, you pitched me the idea, and it is pretty much someone calling in and saying, "Hey guys, I have a massive problem and I need a finance guru to solve it." And I was like, that's Dave Ramsey. Jeremy Anizelli, are you the Dave Ramsey of Australia? Is that what is that?
Yeah, so I'm just,
who you are?
It's on a daily basis. I obviously, as an accountant, that's my forte, but I literally spend 80% of my day now talking 20% tax and 80% solving problems that aren't related to tax. And they're all things that work towards wealth and creation and mindset and just basic things, as I said, little 1%ers to get you over line. And it could be as little as offset accounts, understanding how to use them, to more complicated things of just how to budget in your life. So yeah, it's coming out very soon. So Todd, you've got your plug if you're listening. Thank you, Jeff and Joe. But it's really exciting.
Yeah.
And Joe,
and Todd,
what's
pay
your
us,
content?
pay us for the plug. That was a non-paid for plug. How do we get paid for this plug?
Remember, I'm an accountant, gentlemen. So always trying to find the
move the numbers over. Yeah, go from his account to my account. That's all that matters. Okay, cool. Let's crack on to this. But I'll give you my content of the week. It is a podcast called what is it called? Business Wars. Fantastic podcast. It is done by a platform called Wondery. So if you just type Wondery in, they've got a great lot of business podcasts. Like they did one about WeWork, and it just goes over all of how WeWork came about and crashed and burned and how crazy it all went. But I like Business Wars. It's pitting against two businesses against each other. So like it wasn't. It was Häagen-Dazs and Ben and Jerry's, and how Ben and Jerry's overtook, and just goes through it all. Disney versus
Netflix versus Blockbuster. Did do those two? Sure,
they even did WCW versus WWF.
WWF owned them.
WWE actually. WWE.
Yeah.
Okay. Well, I'm excited to unpack a little bit more. Before we do that, we've got to dive into a quick little ad break, and then we'll be diving in. Ladies and gentlemen, we have a special announcement from the master of commercial property investing, Steve Polisi.
I love commercial property.
Get ready to have your minds blown as Steve is back, and he's got some pretty exciting news for us. Steve is unleashing his second sensational book upon the world, and get this, for the Oz Property Investors members out there, he's giving it away absolutely free. Yep, 100% free. Yep. 100% free for all property enthusiasts who want to learn and grow on their commercial property investing journey. But he's also added a little extra chili to make this deal even spicier. With this free book, you'll also receive a complimentary 1-hour strategy session with the man himself.
Imagine a full 60 minutes with Steve's commercial and property genius dedicated to helping you master the intricate dance of commercial property investing. And who better to dance with? The man who looked better than Patrick Swayze in Dirty Dancing. I don't know about that. Want to grab this offer? It's super easy. If you're live right now, click the link in the comments and secure it today. If not, grab your device, open up the browser, head over to PleasyProperty.com, look for the book page and grab your free copy of Steve's latest masterpiece. And when you're checking out, make sure to use the exclusive code OZPROP to secure the free book and also your free 1-hour strategy session. My only concern with this offer is that Steve's going to have to turn it off soon, as he can only do so many sessions. So if you want to secure your spot, do so today. Oh, nearly passed out there.
There we go. I saw Steve pumping up that, what did he buy for 25 million or something? I was like, interesting. He smashed out a big purchase. Must have taken a bit of negotiation there.
Yeah, $26 million property, big net.
Oh, there you go. It's already gone up $1 million. I thought it was.
I thought it was 27 to be fair, so it's gone up 2 mil.
Oh, okay.
It's a massive deal though, with a cracking net yield, and that is that's the way to do it. I mean, actually, Jeremy. Actually, we got to introduce Jeff. Sorry, I've jumped the gun here, but I am interested about asking about commercial property and some of your more affluent clients. So I'm going to phrase that. But who is this guy, Jeff? Who we got in front of us?
That was supposed to be at the end. I'm supposed to talk about that, but that's okay. We can talk about it now. But Jeremy, I've sort of looked up. I thought you were only 20. I'm going to say you're 20 plus property. I saw somewhere it said 30 properties now or something. So I don't know which you've just.
Yeah,
you've owned a lot of properties, more than many people.
23 properties at present. Was over 30, did sell a number of properties during that COVID pandemic craziness. So it was a good opportunity to pay down some debt and rebuy some more properties. Always looking for constant improvement and pivoting.
Yeah, I like that. But you've got, I think it's over 15 years experience now, and you focus, I think, on small, medium businesses. But I suppose it says you're an enthusiastic property investor, but I think you're like a contagious property investor. But I think the thing I love about you is you love sports as well. So I don't necessarily love that you're I'm not a huge Rabbitohs fan, but that's okay. You're better than us, and but yeah, and you love your cricket as well, mate. And you're also a proud dad. So how good is that? So yeah, that is. I think I botched that a little bit, but you've got a lot of experience and done a lot of fantastic things in your career, and much more to come. So here we are today. So we usually ask people what their favorite property purchase is, but I want to know where you're looking, where you sort of see where your next purchase is likely going to be, like where you kind of seeing opportunity in.
Yeah, so a bit controversial when I say this because it goes against what many people are reading and learning, but I always follow my mantra, and that's going against the grain. At the moment, I'm looking at land opportunities, so vacant land opportunities, and I'm also looking at areas in Victoria as well. While Victoria is absolutely being hammered and hammering still property investors with some changes to landlord rules and land tax changes, as we all know about. There's a lot of areas there that I've looked at that are still anywhere between 20 to 25% below their COVID peak. And, there's a lot of interstate migration that's left Victoria and gone to the more northern states and western states. But it is still and has always won a number of awards of being one of Australia's best cities. It is still the second largest state by population. And I do believe, like anything in life and property cycles, we do see a boom and prices do drop. It does go back to that boom price and plus more. So I do see Victoria as an opportunity, but I also see vacant land as an opportunity because the developers who've been holding the price can't hold it much longer. Land tax, interest rates, opportunity cost, and therefore we're starting to see prices claw back a bit. And same with builders. We all know building approvals down substantially. Builders will have to start sharpening the pencils. There'll be a flow-on effect through deflation. So it's trying to get in early. And being ahead of it, but also being against the grain. So not trying to follow the herd.
Yeah, super interesting because, the way I look at the Victoria market, there's a property that's for sale for $500,000 that sold 2 years ago for $700,000. what's the likelihood that that property is going to go back up to $700,000? So I do think there is some opportunity there as well. But I don't think it's there just yet. But I do agree that if you're the smart money, and if you've got the capacity to hold it, especially when you're buying land as well, there's some real. Are you seeing amazing buys? Like just the agents are constantly calling you back and trying to fight for your deal?
Mostly project marketers, especially the greenfield stuff, they are like, they're crazy in the sense that they're not leaving you alone. So that to me tells me there's a lot of desperateness in their approach, and that's where there's opportunity. You know, someone who's thinking about selling, not really needing to sell, they're not going to give you the best price, not unless you're using a great buyer's agent. But nevertheless, for me, I'm trying to look at lower competitive markets, and at the moment, WA is a very highly competitive market, and without a buyer's agent looking at off-market deals, you're just not going to get in there for the average public user. And that's pretty much very similar for some parts of Queensland. So I've never been one to try to fight the crowd. I've always tried to look at that next key area. So for instance, WA, I was buying there in late 2019 and very early 2020. And majority of properties, and Joe, I've shared with you my story about buying in WA. The properties I'd purchased in WA during that time were on the market for longer than a year, to the point where the real estate agent was saying, Jeremy, just make an offer. Forget about the listing price. Just make an offer. We don't care if it's 150,000 below. Just give us something to go back to the vendor with. And it was even saying to agents at that time when I was making offers, I really don't want to make an offer for this property. And then obviously since then, the market's significantly boomed and will continue. I think there's still a little bit, well, not a little bit, there's still a medium term left to go in WA as their economy's been really ramped up by mining and the price of minerals. So
what gave you the confidence to make that sort of move at sort of 2019, 2020? Like, what did you think that was the time to get into that?
Mineral prices started. We just came off a banking royal commission, and WA got really hit. There was nowhere near the level of investors. In fact, investors kind of left WA alone while they were still focusing on New South Wales as a core state, parts of Victoria and Queensland. So for me, there was a number of days on market. Mineral prices were starting to kick up a little bit, and then COVID and lending really exacerbated the shortage of supply there. So that was a major factor that contributed to why I went to WA. And the same, I look for the same feeling. For me, it's not the numbers. I know many people focus on the numbers, and many buyers agents are data orientated. I like to get the feel. What's the feeling? During the Royal Commission, the feeling was negative about that property or that area. WA, negative. And now Melbourne, it's a very negative feeling for investors. And I know policy and how policy works. Property has to continue to grow for our internal GDP to increase. So governments come in, they'll change. Like land tax went up and it went down, it will find its equilibrium again, and thus will start that second wind.
Well, that's the thing. I mean, the government has printed billions of dollars, and that has flowed through
trillions, probably not. Whatever it is, many billions.
And they've spent a lot of infrastructure money in Victoria, right? And none of that has been realized. Like how much money the property prices, land prices have not gone bananas. But all this new infrastructure, all these builds, all this new stuff is there that opens up the place, makes it better, makes it more efficient. Just hasn't been realized yet. Like we bought a property in Victoria. The purchase, the list price was $560, I think it was, and we bought it for $500. Like $60,000 under market value, right? Like what every bloody buyer's agent wants to say. But it's just creating opportunities and finding a deal that has that potential. 500, great, we'll take it. Otherwise, see you later. No, come back. We need your deal. Perfect, then great. Take it at this rate.
And I think for me, what it really comes down to, and encourage everyone to understand, is how your return's being generated. Generally as property investors, when we talk about return, automatically start to say, what's the rent per week? What's its yield? But property is so much more than that. Property has two mechanisms to its level of return. It's got a capital return, which is the appreciation of the property's value, and it's got a rental return, which is its ability to hold itself and pay for its costs. So do I look at Victoria? Am I going there for a rental return? Absolutely not. You'll be broke after 2 or 3 properties. But if you can really understand what you want to be buying in that area or in that market or in that state, and how to really get the best out of the property in terms of generate that level of return, I feel that Victoria for me is going to give me that opportunity, because there's really great small development sites, 1 into 3, 1 into 2, 1 into 4, which have been crippled by high interest rates and significantly lower building activity. And to me, there's a discount there compared to where they were at the peak of the market. Some of these things are off 200-300 grand and been on the market for quite a while. So that's where I see my level of return. It's not by renting, but it's by buying at the right price, being able to hold it through that development time frame, and then being able to sell it in a shortage housing environment.
Yeah, nice.
And one thing just to flag for some of the new people that may have joined, that are first-time property investors. This is not the This may not be the strategy for you. Jeremy's quite far along his property investing journey. Has the capital, has the cash flow and the assets. It doesn't mean that
has experience as well. I think that's probably the underrated thing that many people like. You can have cash flow and capacity, but if you don't necessarily have the kind of tools in your toolkit to know how to execute this stuff, I think it can be dangerous, even if you do have a lot of properties. But yeah, to Joe's point.
Yeah, because there's still great opportunities over there in WA where you can buy a property for, 550,000, that'll be worth 650,000 in not too much long of a time. And also the rental yield is at 5.5%. So it's like you can have your cake and you can eat it too, but you've got to be able to buy that asset. But Jeremy, you're playing the long game where you're buying a $600,000 site and it's worth $2 million. Like those type of, you're just playing a different game at a different level. But I just want to.
Yeah, it's definitely not for everybody, and that cash flow at the moment is one of the biggest key, and we'll talk about that when we start to go through what I'm seeing from a client perspective, and yield at the moment. Being able to support your property is far bigger than trying to generate really lengthy capital returns. So if you are new into investing, or you've got a couple of properties under your belt, that what I'm doing is probably not for you. You've probably still got a bit more of a core property portfolio that you need to build that is sustainable with good long-term cash flow, so that you can continue to hold this through multiple cycles.
It's a nice little dovetail there, because one of the things I want to talk macro before we get into we've talked a little bit around the rounds, and I know you wanted to ask about commercial property, Joe. You'll get to it. I'll put a pin in that one. But what are you sort of, and throw your questions in as well, people. I'm sort of soliloquying now for, if you want to know about accounting, if you want to know about property, whatever you want to know, drop it in the comments now, and we'll get to it at some stage probably. But I want to know 2024, what does it look like from a macroeconomic? We're talking inflation, interest rates, unemployment, migration. What are you sort of seeing in that space? Are rates going to rise again or drop?
Yeah, I think what it's good to do is, I've done some statistics and we shared this earlier. It's good to kind of look at a cap of 2023 from my view, and then look at of what I believe 2024 will look like. So from a cap perspective, we know that 2023, we've seen interest rate hit all-time highs over the last 12 to 13 years, with the cash rate now being over 4.5%. We've seen inflation starting to come down, heading into a deflating market, changes in policy, obviously through immigration. But in my client base, very interesting statistics I pulled out today for this time, 1,018 properties were purchased by my clients in this calendar year, January all the way through to December. Of which, of the 1,018 properties sold, there were 1,018 bought, and 197 properties sold. So there's a net increase in the client's property portfolio of roughly over 900 properties, of which 61% of the properties that were purchased in this calendar year were in WA.
So in WA alone,
in WA, I couldn't nail down specifics around areas, but 61% were purchased in WA, 23% in Queensland, and then the balance of properties are being purchased in other places. I couldn't narrow down what's PPOR versus what's investment, but I'm assuming with my client base, probably a very large portion is mostly investment. So that's a bit of a cap. That's a very strong property data, and I probably think that's one of the strongest. Now, yes, we've got a large client base, but that's definitely the biggest year that I've seen my clients do. And that's moving into a high interest rate environment where we all thought the world was going to collapse, or at least the Australian property market. So that was very interesting and gave me a lot of solace to say there's not a world of pain out there, and people are still buying. It's just that their values in the property have shifted. And the values have shifted from the eastern seaboard now to a more affordable market, a market that's grown quite substantially in the western area, while people are trying to chase now these yields. And ultimately, Joe, as you know, you've been buying there as well, the values have really increased. My WA properties have more than doubled in the space of 4 years. So, and I still think there's a bit more to go. I haven't pulled a trigger to sell it, because I believe there's a bit more to go. So that was an interesting
demographic.
2023.
Like, what's the demographic of your kind of clientele? Like, how would you describe or paint the picture so we can know the type of person or people that we're dealing with?
Yeah, so I'd probably say on average, majority of my clients would be your middle to high income earning clients. So probably starting at anywhere between 120 upwards from there. Majority in small business or in higher paying income jobs. So I'd probably say a little bit above, what you would determine as the average Australian income in person. But nevertheless, again, just to see over 600 properties being purchased in WA was a huge number. I don't think I've seen a concentration like that ever.
Yeah.
Wow.
Yeah.
And not even with people kind of looking at Brisbane in sort of 2020 or 2021.
Yeah, not at that level. So, because remember, New South Wales was still bubbling quite a bit during that time as well. So there was still a lot of people,
and probably Adelaide as well was kind of kicking along quite well.
That just goes to show it's hot, very hot market.
Because that means they're pretty sophisticated investors, right? Like, this is where sophisticated investors they've got a resource, they've got to allocate it somewhere. Where are they going to put their money? And 61% have put them in WA. Do you see?
Or are they
do you
just
see any,
following
or are they the herd?
Yeah.
No, but where do you see? I guess you can't really see the future because you haven't got the data for the future. But are you seeing a shift in moving to other states, or are you seeing any changes in that? You're seeing more, so 10%, around 8 to 10% of people have sold property. Is that starting to increase? Like, what's happening?
That leads us to 2024 now. So what I am starting to see, and in my client base, I'm starting to assist a lot more people with capital gain tax calculations. So they're starting to provision for CGT. So people are starting to say, my property's done really well. Now, mind you, I haven't really had many clients that have made a loss on property in those 197 properties that were sold. So most people are exiting properties making a substantial amount of coin. But what I'm starting to see is that rates are starting to pinch, no doubt about it, for the people that have started to utilize their buffers. So I'm definitely seeing, and I do believe that number of properties sold will be more in 2024 as people start to say, you know what, I'm overpaying these higher interest rates. I've made a good amount of money. I want to maybe pay down my home or maybe pivot into another area, into another property market. So I do think I'll start to see more clients sell. We do know now that we're in a deflating market. We're starting to see inflation coming down. However, again, I'm not an economist, but I love to say that I am a backyard economist. I do believe inflation still has a lot of pressure, considering there's the back end now of the immigration to come in, although we did see the government this week now change the immigration policy to really scale back down to more normal levels of migrants coming into the country instead of this very exaggerated amount. So that will change the property market too, because now we're going to have less demand, but that will take time to flow through. This is not an immediate light that turns on and off. As we've seen the property market increase, it's going to take a little bit of time before it starts to find its equilibrium again. And that's quite important for many people out there. Equilibrium in the property market is a good thing. We want properties to track at their normal standard rates. When they go up too quickly, we start to see things happen on the other side just as quick. So equilibrium, anyone who's trying to chase 30% growth in 1 year, sounds really good on paper, but if you don't time it, the chances are you'll come out the other side with probably very empty pockets. So stable growth is important. We are starting to see deflation, as I said, across the world. So that means that we'll start to see prices drag. And Jeff, I know you comment quite a bit, and for many people that are out there, interest rates coming down, while it sounds fantastic when you obtain debt, for interest rates to come down, it means the economy is actually slowing. And with an economy slowing, that means we've got less money circulating. We've got prices coming down. We've got less GDP being created, which is what we export compared to what we import, less internal GDP. And what that will tend to show is that we're going to have people losing their jobs, not getting significant higher amounts of pay increases, less jobs being created. So these are all then pressures which deflate the economy. And therefore, if people haven't got jobs and high-paying jobs to pay the things they want to pay or invest the way they want to invest, then it drags prices down. So I always say to people, be careful what you wish for. What we want is a very stable economy where rates kind of trickle along, if anything, just hold, and inflation does hit that target of that 2.5% they've recently come out with. Because what many people don't understand is inflation is cancer. It is that invisible hand, the invisible tax, which really takes your money and your wealth away if you're not investing it in the right spaces.
Just anecdotally, has anybody noticed that over the last sort of month or two that on your average sort of grocery shop, it's actually come back a little bit? Has anybody noticed that, or is it just me? Because I noticed my average shop had been sort of 150 to up to $200, whereas now it's sort of that 80 to 100, 110. And apparently, talking to some people, they sort of saying that they've had to sort of Woolworths and Coles have just had to cut back some of those. They're making record profits.
They're making record profits, right? They were like, "Oh no, inflation! It's going to get."
So I think the government stepped in and said, "Well, hang on a minute." So the
common term is inflation becomes a self-fulfilling prophecy. The more we talk about inflation, the more it's ingrained, the more people have an excuse to lift prices. So the narrative needs to get changed and get changed quickly, because we really shouldn't have inflation at the moment. We've got money being sucked out of the economy, and therefore we should be seeing things starting to come down. But yeah, profits over people. It's always been the big end of town's motto.
And what do you see for the next 12 months then in terms of interest rates? Like, do you see it rising a lot more, flattening, just staying still, or do you see it going up and then boom, down? Like, how do you kind of see it playing out?
Big couple key changes is the Reserve Bank's reducing the amount of times that they meet in a calendar year now. So that's gone from 11 times to now 8 times. Again, at the pressure of the Australian government. They wanted to reduce the amount of times that they have an opportunity of lifting things. So I love that one. That's great. So that's something that's quite important. So I do believe that rates will actually stay quite stagnant, although there's a lot of noise out there to say that rates should actually increase, because to really bring inflation down, you really can't get inflation to meet rates. It's very hard to do. It's that soft landing that they all talk about. The real way to bring rates down, and you saw it for anybody who's watching this, I didn't, but they saw it in the late 80s, rates actually have to go above inflation. Inflation has to come down to target level, and then you start to drop and to see if it comes back up again. If it comes up, you hold or increase. So we haven't got, at the moment, rates above inflation. So there's argument to say rates should increase, but I feel that we'll probably see a stagnant rate probably for the balance of the 2024 year. I don't think we're going to get this reprieve in August. They were talking about late 2023 rates were going to come down. That got scrapped. They were talking about early 2024. Now that's scrapped. So we may see rates hold or slightly increase, but I think we're going to see like this until the end of next year, which is not necessarily a bad thing, because it means that our economy is still trucking along. And as we've seen, and as I've just spoke to you, that was the most amount of properties that my clients have ever purchased in one calendar year. And that's in an interest rate environment, which suggested that the property market should have crashed, and people on the streets, no one paying their debt. And guess what? They're still doing it and finding a way.
Interest
Well,
rates.
it's amazing, isn't it? Like I see it all the time. Like the Sydney boom, and like property prices are so varied. Like if you look at property prices of Victoria, they've been down, prices are down. But if you look at all of Australia, we've started to kind of move up a little bit, but it's really like it's because Sydney's starting to pop off, starting to move up. It's dragged everywhere to make this entire Australia look good, but other markets have done incredibly well. So it's really not. I hate when people are like Australia is just one big market. The property market's doing X. Well, it's not really. These markets have done well, and these larger markets are really what drive the overall number. But it doesn't mean that place didn't do 20% because we've only risen 0.01% of a percentage point in growth.
Yeah.
Well, it's because Sydney was down and Melbourne was down.
Tassie's struggling though. It looks like
Tassie's struggling, but there's an interesting story of Tasmania. For many years, if you looked at the Tasmanian property market from mid-90s all the way through to 2015-16, it did not move. It was very flat. You could have bought a property in 95 for 200,000 and it was the same price in 2015. And then this massive change and shift happened in Tasmania from 2016 all the way through to pretty much mid-2021, early 2022. It went by more than 60, 70% in those 3 years. So if you look at Tasmania as a whole, wow, it's done really well, 4 or 5% each year, but it's only really come in a very small cluster. So again, that's a market where people don't understand this, but Tasmania's population, there's more people living in the southwestern suburbs of Sydney than in Tasmania. So that's a very interesting topic, a very interesting suburb statistic. Adelaide's very much similar. South Australia is a very big state, but what people need to understand,
Adelaide, like it just feels like.
This is interesting statistic, Jeff. Nearly 2 million people live in 1.7, 1.8 million people live in South Australia, of which the population is really densely in Adelaide itself with about 1.3 million people. So if you're investing in South Australia, you've got to make sure that you're in that pocket of Adelaide as opposed to the many thousands of square kilometres that are out there. And the same goes for WA and many other places, very big states. You've got to make sure you find those niche pockets that can do quite well. Where Sydney is a big bowl. Sydney's a big bowl from the Blue Mountains all the way to the ocean. It's just one big bowl. We're very restricted in terms of the geographical and topographical location.
Yeah, it's just a bowl of pressure, right? Like you can't grow up. You can only go up. That's it. If you want to make more property, well, we've got to cut up some of this land, and we need to make this land grow somehow.
Higher density.
So
before we go into more kind of macro sort of moves and all that sort of stuff, or even just less macro, more micro, I want to know, because I'm sort of looking at the sort of 300 to 400K. Like if I've got a budget of 300 to 400K, we're not sort of giving people, saying where people should buy. I mean, it's up to them. But you could have been able to have bought in Perth a year or two ago. Now you probably can't so much do that if you want to buy a green title, as they call them over there. Or even in Townsville, like we're sort of starting to see like that big regional center is starting to struggle to. You can still buy properties for that sort of 300-ish mark, 350-ish. Where's somebody now going to look? But that's sort of starting to become harder and harder. Like, where do people sort of start to, or should they just sort of increase their borrowing capacity and look at the 500 to 600K mark? Like, what does somebody at that sort of price bracket do?
So I think firstly, again, from an observation that I've seen with the rise of Oz Property Group, 60,000 people, well done. And then you've got some other really influential Facebook groups that are out there with thousands of people that are members. And then you've got significant amount of buyers agents into the market. You've got a substantial amount of conferences. Property's the flavor again. What we are seeing is that it's becoming very ingrained in people's investment strategy. Before, you had to have money, you had to have a big deposit to invest in property. It was a very select few, but now lots of people are getting into it and being encouraged to do so at an early stage. So I actually believe that if you can find that $200,000 to $300,000 market and it's got all the right parameters for growth, I think that's actually going to do very well because people want to invest, and that entry price point for many people is just booming. That middle price point, though, believe it or not, that 800 to 1.2 price point, it's actually in the doldrums at the moment. The very high-end price point aimed at premium investors and premium owner-occupiers, it's going quite strong. The bottom market's going quite strong, but that middle area, it's in the doldrums, and that's the space that I'm trying to play in at the moment. Because again, the competition's quite low. It's too low for the premium, too high for the basic. So it kind of leaves, a little bit of fat there to be had. But yeah, Jeff, it's going to be hard to find this.
Like, why does that happen?
It's a tough one. I can only probably say from what I was like starting early on in the property journey, I wanted a number of properties, not so much a quality of properties. So it was really cool to talk about 10 properties, but you didn't tell them they were all worth 150 grand. So that changed. That changed with me. I got bitten a couple of times with buying some lesser end properties. But yeah, I think the price point, entry point, there's a bit of a market for that. Many people already have 2 or 3 or 4 properties and most likely tapped out, Joe. That's probably the common theme that I'm seeing with many clients. A lot of them want to do stuff, but are generally tapped out. And so they're pivoting now. And that's where I believe these property sales that I'm talking about will increase because people will pivot into a different market, into a different property, into a different area.
And where are they allocating that capital, right? You make, 150, 200 grand. Like I had a friend of ours, actually a mortgage broker. He bought a property. He bought it for 508,000. 11 months later, he sold it for 650,000. He got an amazing capital gain. Actually, don't know where he's putting that capital, but where are you seeing like these people put that extra money? Is it going? It's Bitcoin, maybe Bitcoin.
A bit late, by the way, probably.
Yeah. Where are you seeing this allocation of capital? Because it's another problem. You sell a property, you've now got another problem on your hands with all this. Not a bad problem, a lot of money, but where are you going to put it?
Yeah, so the interesting topic that I'm having with clients is very similar to it. So what I'm seeing at the moment, clients who are selling, they're actually upgrading their PPOR. So they've had enough. We're upgrading our PPOR. We're going to now spend 1.5 mil. That's our price. We've lived in an 800 grand home. We now want something more premium. So that's probably where I've seen a lot more people do what they're doing with their money. I've seen a lot more people pivot into away from a balance sheet property portfolio into a P&L property portfolio. So move from growth assets to cash flow assets, irrespective of what they feel that the market or the property might do. They're after just that good, strong, genuine cash flow. So it could be.
Does that like commercial, or is that sort of higher yielding, or is that granny flats? Like what's
commercial and blocks of units. Commercial and blocks of units. People are very much chasing a high net yield, and they couldn't care less if the property grows or not. Can't care. Don't care. Jeremy, if it stays the same for 30 years, we don't care. We're after just the cash flow now. I haven't really seen many people just sit on the sidelines. And for anyone listening, I haven't got many clients that are saying, oh, I'm going to hoard my cash and the property market's going to drop by 35%. I'm going to get into it. I'm actually not having any of those conversations. I don't think many of my clients are feeling that there's going to be a property market crash. If anything, they believe that the property market's still going to remain quite buoyant, but there might be some opportunity with a lesser buyer pool at hand. And we know there's a lesser buyer pool because we're seeing auction clearance rates, I know here in New South Wales, hovering around the 50% for the last 6 to 7 weeks, with the number of auctions being 300 to 400, and I'm seeing more withdrawn every week. So the buyer pools are dropping. But what people also need to understand is that people aren't going to give away their properties. So this notion of I'm going to buy something 300-400 grand below what someone paid for it, very rare does that happen. People will often try to fight and hold on to that for as long as they possibly can.
Yeah, it's my pride and joy. I want to hold on to this. I'm not. Yes, I should sell it, but I'm living here right now. I don't need to sell it.
Or even yes, I could sell it and take a discount. But I've only got 200K debt on it, and it's worth 800. I'm not feeling the pressure when I've got such a low LVR.
Yeah, and the only reason I would sell is to upgrade. And I can't make money to do an upgrade, so I guess I'm just going to have to sit here and wait.
That's it. So that's adding to the supply issues that we've currently got.
It's interesting because this is kind of going back to what I was talking about before, which ties in nicely between your two markets, where the lower end is moving a lot, and the upper end is moving a lot. But it's that middle tier that you're kind of playing in, where you're seeing a bit of opportunity. But that's exactly what I'm seeing as well. I'm seeing the lower end just go absolutely gangbusters. 400, 500, 600,000, that everyday Aussie kind of bracket is absolutely slaughtered all over the country, everywhere. It's so hard to buy an asset within that. And when you start getting into the 800s and a million, easy peasy, lemon squeezy, buy a property. It's the negotiation is so much better. It's that it's just a lot more competition at the lower end. 200 to 300 doesn't really exist anymore. So I'd be very cautious for people to say, hey, go out there and buy a $200,000, $300,000 house. It's very, very hard. I'd probably try and save it up and get a 350, 400,000 before you. Yeah, you don't want to buy. If we've gone through the largest boom in history, and this property hasn't grown from $300,000, it's probably might not be a good area to be buying in. Not financial advice. Yeah.
Even looking at one interesting, I just had a quick look at, because Gladstone's often a boom or bust sort of market, and I just looked at that, and that's even sort of done 30-40% like in the last sort of couple of years. I'm just like, oh geez, it's even getting a bit expensive up that way. Not expensive, but is that because of like minerals? Would you say because the mining's gone quite well, Jeremy? I don't know.
Absolutely.
Okay.
Gas in Gladstone's huge.
LNG,
Got a big mining presence as well. But mining is very strong, and there's still quite a bit of demand foreign. I know China's still got quite a bit of demand, but if you read the headlines, China's potentially slowing down. We won't know, but no doubt about it, mining for the win. It's got us out of a lot of trouble over the last couple of years, and it's got the government out of a significant amount of trouble. The only reason the government was able to post a proposed surplus was because of the mining royalties. So we want to back mining for as long as we can. I know anybody out there is very environmental conscious, but without it, we're going to be struggling from a national finance point of view. So there's a lot of things to suggest that those regional centres, attached to those real mining facilities or mining activities, there may be some strength there. But I've seen Gladstone, I've seen the boom and bust of it. I've seen Emerald, I've seen Port Augustas, I've seen Emeralds, I've seen all these over 16 years of investing, and they are very boom and bust. So if you can time your sale and you're good enough to do that, great, go for it. There's a lot of money to be made. But you just got to be very careful that if you're in it, you've got to ride those waves.
Yeah. I was chatting with someone who had a friend that rides the boom and bust, who is in mining, understands mining, it's his thing, and he bought these properties based on the development of the mining cycle, and knew that new mines were going to open and these ones were going to close, and then he would sell out of these and then buy into here, and he just keeps jumping and shipping. And I think that, it's the unfair advantage, right? If you've got that unfair advantage, go ahead and do it. It's just like house and land packages, right? We tear house and land packages to pieces because they don't have very much value, right? You're paying a lot of money for something, but if you're that 1% that understands that area and understands the land, you can really make value in anything. So it's the same as like buying on a main road. Now I don't buy on a main road, but if a property is $30,000 cheaper, on buying on the main road, it's just going to remain $30,000 cheaper. So if you can get it $50,000 cheaper and you can buy it, aren't you up with that? Not recommending it, but there's always an opportunity.
It's a great point. That is a great point.
What are we on to, Jeff? What's the next topic that we have for this fine evening?
Well, I get a few kind of questions around, like we have sort of alluded to opportunities around sort of, you talked about Melbourne and sort of land in Melbourne, but like where else how do people identify these opportunities? Like how did you, like what's kind of, did you do a lot of reading? Like how do people identify that? Because I think that's something where people are wanting more knowledge on.
For me, we spoke about how I test the market, and it's nothing to do with data. Nothing. I'm not a data nerd.
You just throw it out the window.
It's there. I look at it, but I'm not playing a massive emphasis on it. My one is feel. Always about feel. I'm chatting with agents. How you're going? How many properties you sold? What's the market like? Where are you seeing things? And they give you everything. Jeremy, it's slow. or Jeremy, you know, at the moment it's crazy. We haven't got enough properties for the buyers. So a lot of the agents, they're calling me back. They're having chats for 20 minutes. Normally it's, oh, look, mate, it's under offer. I can't talk to you. We'll chat later on. This time it's a 20-minute conversation. They're spreading their life to me. They're talking about their cat, how their cat had a great weekend. That's because they're twiddling their thumbs and they've got so much to do. So that's how I'm really testing the markets. Yeah, I'm looking at some pockets, and there's pockets that I like because I've been there, I've researched it in the past, I've spoken to people, and then it becomes a feel. I don't want to be fighting 50 people for one property. That's where prices just drive up substantially. I want to be battling myself and the agent for the vendor's appreciation of my price. That's what I want to do. And that's the market that I'm finding, which is giving me that opportunity. And again, then I'll look at a little bit of the data, Jeff. I'm looking at what it sold for history-wise, what's the market doing. And a lot of these, and these aren't areas which are, 50, 60, 1,000 kilometers away from Melbourne CBD. I'm talking 15 to 30 kilometer radius around the center of Melbourne. And for anyone who knows Melbourne, these pockets were all had 6s, 7s, 8s, and 9s and millions on it in the COVID pandemic, and they're all 20 to 25%. Not all, that's a generalization, but some of these ones are 20 to 25% below. So again, my reason is exodus. There was an exodus out. There will be, again, equilibrium. There will be a drive back in.
A reversion to the mean.
Are you focusing mostly on the deal itself? I mean, plus the area, but you're looking for a cracker deal in an area that you like the look of longer term. Is that what your kind of play is?
Yeah, and again, I understand how I'm going to generate my return. My return's not going to come from cash flow because it's not. These things would be selling for $600-700. I'd be lucky to get $400 a week rent for some of these things. So for me, the return is being able to manufacture. Go in there, subdivide it, build it, subdivide, even do a DA and try to sell it to somebody else if there's a market for it. But at the moment, there's not a market for it. If anything, there's many people who have done the DAs and now can't afford to build or go through the cost of holding. Because interest rates and holding costs are quite high, which is killing some people's feasibility or even some people's ability to borrow. And that's where I can come in at that market and make my level of return. So that's where I'm probably seeing me personally. WA, I'll leave that to the buyers agents. They're the ones who are getting the best deals there. Because quite frankly, after some conversations with some very close people I know, they're doing deals and then listing the property, and then it goes under offer within about 10 minutes. So thank you to the person, he knows who he is, who shared that with me about this background of what's happening, and that you can't compete with that. So I'm not even going to try to compete with that. I'll let the buyers agents get their good returns for the clients.
Yeah. I want to go back to 20. I remember we were sitting in your old office. I don't know what street it was on. I think it was about 2015. Maybe 2016. Like what? Because that's when you were sort of you were probably a little bit younger in your investing sort of journey. Like what would that sort of Jeremy have been looking to do in this sort of market? I know it's hard to do, but yeah,
fight the buyers agents in WA.
You would fight the buyers agent in WA.
I would have fought the buyers agents in WA. I would have literally tried to go toe to toe with them and try to get properties off market and battle with them to try to win the deal. That's what I would have done in 2015. I think having a little bit more wisdom and seeing things through multiple cycles now, I've kind of learnt to say, you know what, I won't fight it. I'll let them get the cherries. There's other cherries on another tree that I can find. So that's probably me. New South Wales, I probably think there's a little bit of an opportunity back in New South Wales, but not existing. I think the real value in New South Wales, if you're prepared to buy land in New South Wales and go through the fight with the builders and the battle with the builds, I think there's opportunity there as well. That's probably my New South Wales top tip. Queensland, my personal opinion, whether people like it or not, is it's done a really good dash. Buyers agents and hundreds of thousands of other people all bought there on the Queensland hype. I've seen the Queensland hype in the 2011 to 2013, and I saw it flatline and stagnate when the hype ended. I think that's starting to now slow down. Chatting with a couple of clients and agents that I have as friends there, they're not getting as much love from investors and buyers agents as they were. So there could be a little bit of a slowdown to occur, which means that things are coming back to equilibrium. Not to say that prices are going to come backwards, but more so a little bit of equilibrium. So concept and moral of the story is they'll always find its balance over time. Just sometimes it gets misconstrued, but at the moment the herd is winning in WA, and if you can get in and follow it, and you can follow it with a good price, you'll do very well, no doubt about it.
Because I'm just sort of I looked at and sorry Joe, I'm sort of monopolizing this a little bit, but you look at 2020 2021, a lot of the sort of hype and interest was in sort of South Australia sort of started to take flight then, and even sort of Brisbane as well. Like Brisbane got a lot of love, and even 2022 was still South Australia. 2023 has undoubtedly been Perth. Like everybody and their grandma and their grandma's sort of second uncle. I mean, it's a funny way of putting it. I don't know. Absolutely everybody's looking at WA. It's just so much focus over there. But where like, is there, like, I just don't see that sort of momentum carrying, well, WA for a start, but 2024 and beyond, I just don't know where there's that next sort of 20, 30, 40% market. I just think it's we probably maybe had those sort of really great sort of COVID sort of boom, but I just don't know if there's another state that has the capacity to do that at the moment.
Yeah, Jeremy, what are you seeing in terms of like the ripple effect, right? So the ripple effect is the city market. So let's talk about Perth, right? Perth started to pop off internally, and then it started to broaden out. It started to go from like Armidale is starting to pump up, right? That market has done really well. And then Rockingham has done, Armidale in WA. Rockingham has done really well. And now we're starting to see a lot of people go even further. 2 hours south is Bunbury, Mandurah. Like, what are your thoughts on, okay, well, I can't afford the 500, 600 that Rockingham's asking for, which is 45 minutes away from the city. Do you just keep kind of battling? Do you just keep going further away and further away? Or is there a point where you say, no, we have to wait, or we'll move to a different market? Like, what are your thoughts of those type of investment decisions?
So for me, my 2024 year is all about value investing, not investing for the sake of investing. It's all about value investing. And if I'm going to start going further and further and further away from major capital cities, well, then I've got to start looking at other states and comparing apples with apples, and start looking at, well, what is 2 hours, 3 hours south of Sydney get me? Well, some of these prices are getting you very similar to places like Nowra. Nowra in the south coast of New South Wales, or you start getting into northern parts of the Hunter region and slightly even further west of the Hunter region, which I would say in comparison is slightly better than some of those areas on a same price dollar for dollar basis. So value investing is key. I don't think we just start going further and further and further away for price point, because when does it stop? And for me, 2024 is the opportunity and the X factor. The clients with very strong portfolios, the sophisticated investors, what they're doing quite openly, gentlemen, is they've bought their properties where they've got that X factor attached to it. They believe that it might be a little bit of a flat 2024 in terms of a property market, despite what the headlines are. 6 to 8 weeks ago, it was a boom 2024. And then I heard Westpac and a couple others came out saying there's going to be a decline now in 2024. So you can't really follow. You can't really follow the banks because they've stuffed it the whole time. So the sophisticated clients I've got are saying we're going to buy properties where we can manufacture value in 2024. We can put granny flats on them. We can do cosmetic renovations. We can do small renos. We can do landscaping. We can add additional rooms. So that's going to keep the property market moving and these clients making money. They're not relying on capital growth, they're buying in the right area for the right price, but they're buying at market value properties today, and they're saying we can generate this over the next 12 months by doing X, Y, Z. So that me is essentially what I'm doing with my purchases. I'm looking to generate my level of return now, not through rent or cash flow because interest rates are quite high, but through value investing.
Yeah, value investing. That's a great way to put it.
Let's bring this. This is potentially a spicy, maybe not spicy, maybe a little bit.
2025 to 2026, all these 700,000 of immigrants will be looking for homes to buy after being here post-COVID. The boom will be across the country.
That also is
Your
supposed to
thoughts?
coincide with that 18-year property cycle in 2025, 2026 being the blow off top. So I don't know, Joe. I know that Joe and Jeremy have chatted about that, and I sort of.
Mm,
So how does that sort of all play out?
The
Like,
book
is it
right here.
I'm trying to get a
there you
cue? I
go.
have to message him on
This is
LinkedIn.
the most. This is the most
Well,
dog-eared book that I have.
yeah,
It's
well,
very, very good.
first and foremost, we know now that the number of migrants to come into the country post next year is going to be less per capita per year. So we're not going to have this huge 400,000 that we've had. Yes, these 700,000 migrants that are currently here. To answer this Facebook user's question, they're already living in a home, in a rental property already. So the people that will come in may find it a little bit difficult. But what the government's doing to incentivise permanent residency and other classes of visas is that they've got to move quite regional. So if all 700,000 people were to reside in the southwestern suburbs of Sydney or in Cronulla, in God's country, as they say, then yeah, Cronulla's going to go bonkers. Cronulla's going to go bonkers, right? There's not enough houses to house 700,000 people. But if that's quite widespread, very widespread across, Australia, that's not going to make a massive difference. It's the longevity. If 600,000 were to come in every year on year, well, that's 6 million over 10 years. That's making a massive impact on the property market. So Labor governments has definitely bowed down, and they've reversed their migration policy as a result of the housing crisis we've got.
Well, what did they promise that they were going to build? Was it 1.5 million properties?
1.2.
Was it 1.2? And they've never hit that. They've never hit that number whatsoever. The closest they got was, I think, in 2018, where they built 1.01 or something like that.
That was over a 5-year period, so they'd have to build 250K or something, 1.25 million. So they'd have to build 250 per year to get there. And I think the most that's ever been built was like 200 or 220. Does that sound familiar, Jeremy?
Yeah, and that comes in from the Future Fund that Costello and Howard created. But the only way we're going to get there is through high density housing, like units. The problem is that we're plagued by terrible unit builders. People have lost faith. So we're not getting the private market buying truckloads of units like they were many years ago because of all these terrible stories. So things will have to change. And in the end, it's the private market. It's you and I. It's the investors listening here tonight. We're the ones which will be able to alleviate the property market problems or exacerbate it even further if we're not turning over property. So we need a buoyant property market to house people and to ease, believe it or not, housing crises. So it goes against what we all hear. We need property market to do well to ease the housing crisis.
Well, right now rents are going absolutely bananas. That's where these new immigrants are going. They are going into these rental properties. That's why we're seeing this massive increase in rental prices across Australia. Vacancy rates are sub 1% or 1.1. But they'll eventually shift. Like, these people aren't coming here with no money. But also, I think if we keep building, if we get to that number, there will be a period it might even tie in nicely with your 18.6 years there, Jeff, where there's a massive oversupply of houses because we went too crazy. It's very interesting that the government, I thought that it's very interesting that the government decided, slow down the immigration tap.
Well, they had to, because otherwise it would go too crazy. Like, you just have But interesting. I don't know if you guys have opinions on this, but we'll tackle it anyway. Since we're talking about what 2024 is going to look like, I don't know Cairns all that well. I did visit there once as a 5 or 6 year old. I held a crocodile with a tape across its mouth, so that's about my knowledge and extent of Cairns. So forgive me, I don't have too much an opinion on Cairns, but you've been up there, Joe, I think, and Jeremy, I don't know if you've seen much about. Yeah. So do you have any thoughts on Cairns, people?
Well, right now it's pretty, like someone said in the comments, it's pretty windy right now. Was it Jasper? I think there's Cyclone Jasper.
Cyclones, yeah.
Hopefully everyone's all right. It's up there.
From an investment perspective, like Cairns itself is getting a lot of money thrown at it. So there's a lot of road upgrades. The Cairns University is getting pumped, $165 million. Big infrastructure projects are going in. It's very affordable. It's a nice lifestyle. But some of the downsides are insurance. There's a big insurance cost, and council rates as well. So there is a large council rates that comes in, but also council rates are factored into the water rates for Townsville and I believe Cairns as well. So it's also like you see a big number and you're like, whoa, but you don't have to pay the water rates. But I would just have a look at some of the, like Townsville, for instance, flooded in 2019. But it was interesting to see what the property market did over that time. So this whole Jasper thing, not very good right now. Not ideal that there's a cyclone that's going to rip a whole bunch of roofs off. But that's why you have to pay $2,000 in insurance, $3,000 in insurance. So for me, it's a very affordable market. I'm seeing a lot of, like what you're saying, Jeremy, that lower end of property investor who has $200,000, $300,000, $400,000 putting money into these markets because one, they see a 6% yield and they're like, OMG. And two, they're like, I want to invest. Where can I invest? I have no choice but to invest. I feel like I took over your question, Jeremy. What are your thoughts on
Yeah,
Cairns?
look, I actually think Cairns will do all right. The domestic travel market at the moment there is quite strong. And that's because we all want to travel and Cairns is an affordable place for us to still get away. If the domestic travel market does soften, that is an area which typically has done very poor. So if you look at Cairns, if you get a chance to, anyone gets a chance to look at Cairns from 1975 through to now, you'll see that it went a huge spike in the 80s. Everyone was buying properties in Cairns. That was the go-to place. It just went bonkers. One of the most expensive places in Australia at the time. And then in the 90s, it really flattened off. And 2000s, it had a bit of a blip and then it flattened off and went down again. And we're starting to see a big spike. So that is a very wavy property market there. Domestic travel up, Cairns great. Domestic travel down, Cairns economy is going to really suffer locally.
Yeah. I actually have a friend who...
It doesn't look all that affordable either. Like you kind of think that you could buy it. I mean, I suppose relatively it might be, but I just had a quick look at some of the suburbs and there's sort of still that sort of, for a house, you're looking at $450 and some are up to sort of $550, $600 median, and medians are imperfect. So, but I just think,
you say that, like, I have a friend, and I think I mentioned this last week or the week before.
Moved up there.
Yeah, $220,000, $300,000, high end, like high tech, prop tech startup company, and he's like, screw it, I'm done. I'm moving out of Sydney, and I'm going to do my job up in Townsville. He bought a $450,000, $500,000 house with a pool that overlooks this amazing view, and he's like, yeah, this is life now, because it's beautiful. So the lifestyle is definitely a big driver, and affordability, but I don't know if I could live up there. Maybe. We'll see. Maybe not. You never know. Okay, well, let's jump into one of our final ad for this evening, and then we'll jump to some of the questions that we've got and some of the predictions. Something else, Jeff?
There's nothing worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands, and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you ever make. The best decisions.
So we are back.
We are back.
The reason I sort of chuckled a little bit when you said predictions, because I feel we've had a lot of predictions. So I mean, you can if Jeremy's got more, I'm sure he's got more predictions in his bag. But we'll throw to what I want to hear, and throw your questions in, people. It can be about accounting, because Jeremy literally deals with sort of thousands or his company deals with thousands of, his company that he helps run deals with thousands of investors per year, and they are sort of property and sort of doing that tax as well. So drop those questions if you want some intel on that. But Jeremy, what I want to hear though is I want to hear beyond 2024. What are the most what are the people that have been in the game? What sort of things should they be sort of, if people want to become and emulate, start to look at these people, what should they be doing?
So the biggest thing that I'm seeing the very, very wealthy people do at the moment is the protection of their borrowing and pivots. So a lot of people now are, and again, sophisticated clients are pivoting out of properties where they feel that, again, their return has been generated from a capital point of view. And they're focusing and having a little bit more emphasis on cash flow. So a lot of people's property portfolios are evolving. The biggest thing that I explain to people all the time is that sometimes it's not a bad thing to sell a property, because you collected money that someone else has paid you. If you go buy a Ferrari or you go on a very expensive $200,000 holiday, well, you've kind of whittled all that hard work away. But if you pivot that into a much better performing property, again, a property where there's value investing attached to it, that's where you're going to see the higher dividends. So I think people need to be a little bit more creative now if you want to get the level of gains that you've seen over the last couple of years. I don't think, and again, very important that we understand economics. We had over 600 billion pumped into the economy, JobKeeper, JobSaver. We had no one lose their jobs while working or living at home doing nothing for weeks on end, getting their $1,500 a fortnight. We had ultra low interest rates and a significant amount of bonds being issued into the market. We had a perfect storm for asset increases, significant amount of capital, lighter and more lenient lending market environment, and a substantial amount of profit all being made. Hence the reason why now we've got substantial inflation. So if you want to start continuing to get those gains, you've got to be very creative with your portfolio. And the wealthy people that I deal with are pivoting, and they're moving out of potentially capital assets and moving into a little bit more cash flow assets. So that's one thing that I'm seeing. I'm seeing a lot more people add income generating dwellings onto their property, like granny flats, or if they've got an opportunity to subdivide, this is the time that they're doing it. They're subdividing and building, because that's where they're manufacturing their level of equity. And the last thing I'm seeing people doing is borrowing preservation. They're being very strategic with their borrowing. I'm seeing so many more people becoming much more, the best word is intelligent with their finances, as opposed to this endless amount of money that they're getting given. And the buffers. I'm seeing a little bit more people build up a bit more buffers, because they know and prepared to ride out this little bit higher interest rate environment for potentially now a little bit longer. You know, this instant rise of rates and this instant come down of rates, we all thought it was going to happen fairly quickly. It hasn't. It doesn't look like it will. And that's where your buffers will get you through to the next cycle. So we've all got to remember, we're probably now into a new cycle. We've just finished a really crazy one. The new cycle now might not be 30% gains. It might be smaller ones, but if you can hold or stay in it or increase the value, ready for the next property boom, that's when you're laughing.
So when you say buffers, what are you kind of seeing some of your more smarter investors, or maybe, and not necessarily like the super well off, because I imagine the super well off are just like, yeah, I just put $1 million here. But like, what is a good buffer, general good buffer to have for a property, or what you typically see?
Yeah, so 2 to 3 months of the property's costs without any rental income that you're earning. So picture the property's not rented for 3 months. You want to have 2 to 3 months worth of the property's costs, interest, insurance, rates, and that's going to see you through, because properties are aging. You might have a cyclone that goes through, or other things like that. You need to make sure that you've got sufficient amount of capital to pay for these costs. I am seeing clients who are struggling, who can't put new hot water systems into their property. They can't afford it.
Wow.
You know, I've seen lots of arrears. There is definitely arrears being building up in the market. Again, this goes back to having high rents, and charging your tenant a substantially high amount of rent sounds really good on paper, but if they can't afford it and the market in that area can't afford it, there's no point charging $600 when the market can only afford $450. So many agents will tell you that arrears are starting to build.
And how much is that? So how much does that work out to be? What, $5,000 or 10 grand per property? Like,
yeah, it depends on your property's value and how much loan you've got. But I think a very careful buffer is anywhere between that 5 to 12 and a half, 13 grand. I think that's pretty more than enough. Absolutely more than enough.
one of the things that I'm seeing, and I can only tell you what I'm seeing. One of the things that I'm actually doing as well is going through the portfolio and refinancing it out, and then pulling the equity out that I've gained and sitting it in my offset. Am I going to do anything with this capital? Not just yet, but it's dry powder when there's an opportunity, or it's equity that I can pull out and put into my account, and when I need it, I can use it, rather than not being able to pull it out when I need it. So you just got to be wary of the banks constantly shifting and changing their ideas. So if you can pull equity out, put it to a side, do that. I've got it's amazing how many people that I speak with, they're like, cool, Joe. Yeah, we've got this amazing strategy, this amazing plan. And then 3 months later, oh, we have a kid. Oh, we've broken up. Oh, this life thing happens. And all of a sudden I've got a new job. Great. You've got 3 to 6 months without being able to borrow a property now. So
you can borrow almost straight away, Joe. Potentially, there is a really big bank that may consider it. But sorry, potentially, you're right.
I'll share with you a couple. It's quite funny we're talking today, because in the last week I've had 4 people with very similar scenarios. Now, no one's going to shed a tear when I talk about these particular examples, but I've had 4 clients, very much similar condition, all very asset rich. Their own home is worth $6, $7, $8 million. Boo-hoo. I agree,
Jeez.
right?
Oh,
bad position to be in. Their debt on their own home is about 1.5 to 2.5 million. So again, higher debt and very manageable when interest rates were 2%. Their rates are all now 6.5%, and they're struggling. They're really genuinely, living in an $8 million home and can't afford to put food on the table, have no buffer. They're praying for an electricity bill to come in much cheaper than they thought. And they're holding on to these properties, and they're having a chat with me saying, Jeremy, what do I do? Guys, if you can't hold on to the damn thing and you've got $6 million worth of equity, sell the damn thing. It's capital gain tax free. Go buy a house you can afford, no debt. Have some money that you've got now to invest into the market. And they think it's better than sliced bread, the advice they just got. But it goes to show that even when you've got a substantially high asset value, you can be capped out from a borrowing point of view, and having that powder that's dry is going to give them an opportunity. Now, they will substantially build far more wealth doing it that way by downsizing their home, releasing the capital, and then going out and investing in various different assets. So that you just got to be savvy now with what you think, and hence the reason why I said earlier, I do feel that there'll be a shift on selling and people taking profits and maybe downsizing or pushing that money into other areas.
So
and it's just not. I was going to say it's just not worth it as well. Like, what's if you're sort of worried about how you're going to pay the next bill, or how you're going to pay the $20,000, $30,000, $40,000 private school fee next year. Like, I don't know. I just think, well, what's the point of it all? Like, why do we need to sort of go for all that if you've got the solution? And I suppose it's sort of saying that common sense isn't all that common. But go on, sorry, Joe.
Yeah, but when you live in an $8 million house, can you go back to a $2 million house? Like, I flew first class, and I really don't want to fly economy anymore. Not that I fly first class.
Otherwise, but if you don't, what's the point though? If you're lying awake, if you get ulcers and die at 45, then I don't know.
Exactly. Just enjoy it. Enjoy it. Spend it all. There's someone that's pointed me out and said, Joe, are you saying pull out as much equity as possible and just keep it in the offset ready to go? I'm not saying anything. That's what I'm doing.
Put the disclaimer up, Joe. Damn, put the disclaimer.
It's not the financial advisor, but I'm doing that because not financial advice. I think this little thing pops up. It just allows me. Nothing changes for me. I pull the money out, I put it into my bank account, and it's still offset against my loan, and it allows me to have 200 grand just sat there doing nothing. And if something happens and I need to use it, there's a great opportunity, a great investment. Great, I can go for that. Or my $8 million house is really struggling. I can actually just eat into the debt because I know that eventually it'll turn good I don't know. I've got it there just as a bit of a buffer and a bit of a security,
Yeah.
just in case.
Greg
Hey,
asked
Jeremy.
this question. I really want to because I think a lot of people will love it and resonate with this sort of question. So Greg says, "Hi Jeremy, very green investing. 15-year plan is to accumulate properties to create passive income. Isn't that hopefully that's everybody's goal? Hopefully it's not to not create passive income. Should I aim to do that under a company and purchase via trust? What would a blueprint for me to set up now instead of scrambling after a couple of properties?" Geez, this is a big question.
All right. I'm going to bust a couple myths because there's so much topics and conversation going around trusts and borrowing capacity and when to go into a trust and all these other things. Now, I spoke about this quite publicly well over a year and a half, 2 years ago when it was relatively new and learning a lot more about it. Now, I've always made a very strict comment. The first 1 or 2 or sometimes even 3 properties, I like to buy that in individual names. Circumstances will change that, very rare. Now, the reason for that is we want to keep the costs low. Trusts are not cheap to establish. They're not cheap to run. They are more complex, no doubt about it. And generally, the reason why I like to say the first 1, 2, or even 3 properties individually is I want everybody to have a very simple and a very low cost investing experience to initially start off. Land tax comes into consideration, higher interest rates at present. This negative gearing is going to assist in some circumstances depending on the way people are buying. Now, depending on the property you're buying, and there are exceptions to the rule, if you can get a property that's inside a trust that's able to meet its own commitments without any further capital required by the individual beneficiary or director of the trustee, and it's able to stand on its own 2 feet, no assistance, then yeah, you do get to negate that debt as long as you purchase in a subsequent entity. I've had that speech about 500 times. But the reality is that if you're going into a trust sometimes too early when your income's 50 grand and you're 2 years out of uni, I can definitely put my hand up to say for 99% of people, your income only grows. And with your income only growing, you're making decisions today and entering yourself into a sophisticated structure before you've even reached maturity in your employment or in your own business. So keep things simple to start with. That little bit of negative gearing that you may have depending on the leverage and the rent and the interest rate of that particular property, sometimes it's what's going to help you get through to the next property or even to hold that property long term. The first couple of properties I purchased, not 5, but 2, the first couple of properties I purchased, I bought them in my own name. My interest rate was with ING Bank and it was nearly 8%.
It's amazing you actually got a loan with ING. I didn't think they approved loans. I thought they just what do they do? Like, how do they?
Yeah, back in the late 2000s, they approved loans.
Premium client.
That's it. But my interest rate was nearly 8%. Without that level of negative gearing at that time, and mind you, tax rates were much higher than what they are today, I wouldn't have been able to even move out of home. I wouldn't have been able to save any money. So I kept things simple. As my income grew, as I moved from a graduate accountant to associate and then moved into other things, senior accountants and managers, that's when my income grew and my borrowing capacity started to open up and I was able to become a little bit more sophisticated with my structures, and I'm happy I did that. So to answer this person's question, start with the first 1 or 2 in your own name. Rare exceptions as to why you'd go into a trust, and then without a doubt, a trust should form part of your portfolio, but the right property needs to be matched with the business strategy of the property, then needs to be matched with the structure. There's no point buying a property that you may move into a trust because the CGT exemption that you lose is far greater than the small amount of borrowing capacity or benefit you might achieve in the future. So really need to make sure that you've got those 3 things aligned. Purpose of the property, business strategy of the property, and the structure needs to come together to make the right decision.
Yeah. Because
somebody
sort of said,
get very heated about that topic.
I think people just need to rewind that and go back and re-listen to that, because there's so much value in what you just said there, talking about structure and trust, because it is very confusing and everyone gets so excited about, I'm getting a trust, I got a trust, and sometimes you don't need it, but other times, absolutely, yes, it can definitely help you take that next step, but
well, because somebody sort of was saying, oh, it can be costly to go from it can stop. Yeah, you probably got a message about that as well. I saw that. I was like,
thanks, Jeremy. I'm going to listen to it another 15 times. Yeah, I'm with you. I'm gonna rewind it as well.
Somebody, you may know a little bit about this because somebody asked about NDIS and HMO. Like I wasn't going to ask you. I don't think I think it's too specific. As in, I don't know if enough people are going to be looking at that. But what are your thoughts on NDIS and HMO? Are there opportunities there, or is it just too challenging?
There definitely are, but I've seen all this before. I've seen National Rentable Affordability Scheme and NRES come in. It was the hype when it first started.
Nice.
I've seen Defence Housing. It was the hype when it first started. And this is the same as NDIS and HMO and all these other things. I believe anything that's tied to a government incentive, anything that's tied to a government surplus of funds that they're providing, you've got to be very careful, because different governments come in and they change policy very quickly. Do I think NDIS is going to stop overnight? Absolutely not. What's in the news at the moment that Bill Shorten's going through is a huge NDIS review, because there's a huge amount of rorting going on in NDIS. So they're going to be heavily reviewing it. They're going to be heavily monitoring it, because it's a cost to the taxpayer, which has now exceeded the cost of what Medicare is, and it's done it in about a tenth of the time. So if NDIS keeps tracking the same way, NDIS is going to overtake the defence budget. It's going to overtake the Medicare budget. It's going to overtake the infrastructure budget. We might as well be working for NDIS. That's it. That's where our tax dollars will go. So be very careful when you're pinning your hopes onto one specific government stimulus package. You've got to make sure that when you're investing, you've got to understand how you're generating your return and the longevity of that return. That's important.
So what's going wrong with NDIS? Like, why is it going so crazy and expensive?
It's just excess.
Underestimated the amount of people that would be on it. There's obviously fraud, because it's a substantial amount of government initiative, incentive, and stimulus being poured to it, and it's hard to monitor. It's very hard to monitor. So many people on it.
How do you monitor it? Do you pay people to monitor the people who are supposed to be monitoring it? Like,
and look, I think NDIS.
Bureaucracy.
Yeah, I'm a massive supporter of NDIS. I think it's a fantastic initiative for the people that need it, but there is price gouging going on. As soon, like a wedding, anyone who's got married, you'll know. All the wives out there, put your hands up. As soon as you say you're getting married, the price goes up another 1 or 2 zeros, and that's the same. That's the same as NDIS. There's another zero being added on in some circumstances. Why? Because the government's paying for it, which was really us as the Australian taxpayer.
Yeah. There's a question here. I'm a rookie here, and I'm still processing capital gains impacts related to trusts.
Oh, sorry. Do you want?
Yeah, pop that one. Oh God, yeah. So, can you get high level? What does that mean? Capital gains. What are the capital gains impacts relating to trust? No personal advice and all that stuff, but so how do we think about trust and CGT?
I think a trust from a tax point of view is the best entity, one of the best entities, not better than super funds, because super funds have a 10% tax rate if being held for longer than 12 months. But for trust, one of the best structures to minimize tax. If you're distributing to an individual, the individual gets the 50% discount on the distribution that they received, which is essentially where people say trusts get a 50% discount if you're distributing to an individual. If you're distributing to a company, there's no 50% discount. So that's one point to remember. But the ability to be able to distribute profit to the beneficiary with inside the deeds that has a lower or significantly lower marginal tax rate than you, wow. I've used it for my clients so many times. We've sold property. Oh, I love it, because we're talking not thousands, we're talking tens of thousands and hundreds of thousands. And I can probably say I've saved millions of dollars in tax legally by using the right structure. And that's, again, a great example. Sold a property. The wife went off work for maternity leave. They had no real ambition for her to go back very soon. We saw an opportunity to sell the particular property. She had some capital losses from some share investing that she thought she would do many years ago, which didn't turn out well. Sold the property, distributed the capital gain to her, was able to absorb her capital losses, and was able to take advantage of her very low marginal tax rate income. We saved the client, if they bought it in their own name, 40, 50 grand in tax. So the trust gives you a substantial opportunity to be able to pick and choose the right beneficiary strategically at the right time. And that's what investing in your own name doesn't allow, because it just holistically pins it to you, which means that that's it. You sell, you're in that structure, you can't do anything else, which is your name. So that's a little bit about how the CGT Impact works and where you can flow it.
People get really excited about trust, don't they, Joe? Like, you just see the questions start flowing through when we talk about trust.
I love a good trust. I mean, it is pretty crazy that these structures actually exist. Like, what why do they exist? Tax minimization.
Because the politicians have them, Joe.
And property. I want to know. Well, there's one question that I think is going to be interesting. And there's another, or that's my own question that I think could be valuable for people. And there's another one more, and then we'll finish off. So, what do you sort of think about combining? Like, how do you collaborate with brokers and maybe not so much conveyancers, or solicitors, but probably your broker? Like, how often are you talking to clients, brokers, to make sure that everything's aligned? And what does that look like when it works well?
All the time. So I got a frustration with the mortgage broking industry. I've got a pain point. Anybody who treats their broker as a transaction-based professional, similar to that as a conveyancer, how many times do you pick up your conveyancer and chat with them throughout the year?
Hundreds.
No, you're a buyer's agent. It's not different. You've just bought a property, and
Never.
How many times, as you as an investor, do you pick up the phone and have a chat with your conveyancer? Never.
Not all.
That's a transaction. That's a transaction-based professional. Your mortgage broker is a journey-based professional. Your accountant is a journey-based professional. If you've got an in-house solicitor for your business, it's a journey-based professional. Any broker out there that is treating their client as a transaction, change the way you're doing business, because you won't survive a very long time. Any investor out there that is treating their mortgage broker as a transaction, change the way that you treat your mortgage broker. Be on a journey with them. Share with them your goals. You should be touching base. Get a feel of what's happening in the market from a finance perspective. I speak to my brokers and bank managers all the time. I want to know what rates are out there, what policies are changing, who's taking construction loans, who's not taking construction loans, who's at the moment changing policy, who's changing buffers, what's Westpac doing, what's CBA doing. And one of the key things to my success in property investing is not being a guru on the property market. It's knowing how to finance the deal. And that's been my strength. People ask me all the time, how'd you get to 30 plus properties? I knew how to get the finance to say yes. I knew what structures to get into. I knew the type of covenants, what properties were needed to help me get there. I knew when to sell. And for me, selling, almost over 12 properties in the late 21 and 2022 period gave me a great opportunity that I'm in now, because I lowered some of my debt in my trust to negate it. And then now I'm in a really good position from a borrowing point of view to go bonkers. So that's because I knew finance and knew how to set myself up to move forward. So speak to your broker like a journeyman, not like a transaction. Brokers, treat your clients and go on the journey with them. Don't treat them like a transaction.
Yeah, and it's so easy to do that. Like my first mortgage broker, I walked into, I forgot what it was, like a Rams or something like that. And the guy was like, cool, I'll get you a loan. That's absolutely fine. I'll just go get you the thing. And I know about investing. I'm like, great, where are you investing? And he gave me these absolute rubbish locations looking back. And I just felt like, and he's like, great, I'll get you the best rate. It's absolutely not about the best rate. It is about the right structure for you. Like he's like, I'm like, do I need an offset account? He's like, no. We want the best rate. The best rate doesn't give you an offset account, so you don't need that. And that offset account saved me tens of thousands of dollars, whereas that rate would have cost me multiple thousands of dollars. So it's make sure that you just speak to someone that's investment savvy as well.
I think the main thing is, as your broker is getting you property number 1 or 2, get them thinking about property 3 or 4. That's the level of professionalism and nous that you need from your finance professional.
And what sort of questions do you typically sort of get? Is it well, how do I get to 3 and 4 from here? Like, what steps do I need to be making, or is it other sort of questions?
A good broker should be encouraging you to chat with your accountant about, hey, we're tapping out here. We need to talk about structure. Have you opened doors? You've got $350,000 in super. Based on your super contributions, this is what potentially you can look at doing. It's not advice that they're providing, but they're opening the door for conversation with other professionals. Guys, if we do go down this path, this is what we need to be doing. Brokers, They don't want to, you don't need to do a top up of 20, 30 grand. I understand as a mortgage broker, it's a lot of work that they don't get paid for. I understand that. But it's the journey you need to take with your clients to get them property 3, 4, and 5. They're the things you want to be asking your broker. They're the things you should be getting, leads in conversation that your broker should be initiating. So finance is one of the most important.
Initiate that conversation as well. Like what I was just saying about refinancing and changing my loans. My broker reached out to me. He's like, "Hey, Joe, you thought about your loans?" I'm like, "No, I've just been too busy with work. I haven't thought too much about it." He's like, "But you're paying a ridiculous rate here and a ridiculous rate here, and you've got $200,000 worth of equity." I was like, "Yeah, I should probably do something about that." He's like, "Yeah, you should. How about you just put it in an offset account?" And I was like, "Yeah, of course. Well, I tell people to do that every day, but I'm not doing it. I'm like the electrician with a broken, faulty wire."
And your broker wouldn't have got paid an upfront for that 200,000 that you've extracted and put into the offset. Nothing. So they've done it out of the love of their own heart. But what that has given the broker and you is an opportunity to go into your next deal.
Yeah, exactly. Now we've got the powder dry to go again, and that's the great thing about broker. Yeah, you do. Yeah, everyone just pick up the call. It's like Christmas. Yeah, it's like Christmas. Take the time to call those people you haven't called. Say Merry Christmas. Call your broker and say, "Hey, it's about time we have a chat. Hope you've been well. Give me some finance because I need to buy another property."
Let's I reckon let's finish up on this question. I know there's somebody asked about HMO. I don't know if you're great.
Same thing.
But I think HMO, this one's a great one to sort of finish off. I think I know the answer to some of this, but this is from Ben, and I think it'll help hopefully a lot of people. But he asks, how did you know what to do when you're buying your first property? Did you have a mentor or guide, etc.? I know your dad heavily influenced you. I think
dad and my business partner as well was very big in property at that stage. But I have to say, I'm not old. I'm not 55 years old, and I was looking back at the paper like. I don't know. I think we're the same age, but I wasn't a newspaper investor that looked at the newspaper to find the property deals, right? I'm not that old, but I didn't have Facebook groups like you guys. There wasn't as many seminars around. There was 2 buyers agents at that stage back in the mid 2000s. There was nowhere near the level of content that we see today. So people saying that they don't have a mentor or a guide, unfortunately, Mr. Facebook user, it's polywash. And I say that why? Because there's so much content out there now on YouTube, on Facebook, and all these other things, seminars and buyers agents and all this giving free information. You don't necessarily need a mentor or a guide. You just need to spend your time, listening to things like this. Attend as many different seminars. Jeff, you and I, we attended many seminars together, traveling all over New South Wales to do it. As young men, and that's how we learnt as well. So to me, I look at Jeff as my mentor, as I did with my father and my business partner Manzurul. Why? Because we were together listening to the same content, and we asked lots of questions to each other. So anyone that's out there, you don't need someone who's dangling the carrot in front of you, giving you all the answers. There's so much content. Learn, listen, and pull the trigger. What did I do when I first bought my property? I found somewhere close that I knew, and I pulled the trigger on it.
Was it Campbelltown way?
Campbelltown. It was not below market value. If anything, I probably overpaid for it. But I wanted to buy a property that was safe, sound, and wasn't going to give me a headache. So it gave me a great taste into the property market. That's all I wanted, something that was safe, sound, and a great taste in my mouth. And then as I grew, income grew, appetite for risk grew, then I started to change, pivot, and play in different spaces.
Yeah, and that's the great thing about podcasts as well. There's a lot out there now. I mean, that was some of my first mentors were was it Smart Property Investment? SPI? Is it Smart Property? Yeah,
that's SPI.
They were growing their portfolio live many years ago and loved it. And then they'd bring on guests. like that's what you pick up. You just pick up those people along the journey, and then live sessions.
I tell you what, I love, Joe. I love the smart property, your property investment and the API as well. Like I used to love reading through those investor kind of profiles and just sort of. That's how I reached out to probably quite a number of people I still keep in contact with now, who were sort of starting their journey and all that sort of stuff. So, I mean,
cool.
If you reach out to me, I'm sorry, I'll probably respond to you in 2 years' time. I do, yeah. I'm not saying I'm too important or too busy to respond, but.
Okay. Speaking of, we're wrapping up here, but there's a great question here. I actually wanted to get.
We have to answer.
I do want to get your opinion on this. I know you've almost finished, so that's nice of them to acknowledge that. But I am a first home buyer. Should I buy? And now when they say home buyer, I'm going to assume they're meaning investor rather than PPOR purchase for their home.
Yeah.
Should I buy new so I can depreciate, or should I buy an existing property?
Somebody
what do you see? What do you see happen in these scenarios, Jeremy?
Yeah. So first and foremost, we start with the old sentence: negative gearing is not a strategy; it's an outcome. You do not buy something to lose money or to buy something that depreciates quite heavily in value just to get a refund. You'll get bitten in most cases, more than not. Now, in saying that, I'm always focusing on the area. If a new property in that area has the capability of doing well, and I've bought and built new property in new area because I've invested because of the value of the area, not because of the property itself, then that's fine. Whether it's old or new, it does not matter. But to just pigeonhole, I'm buying new because of depreciation and I don't care where I'm buying, go buy in the middle of Burke, overpay for it. You won't have any capital growth and it'll cost you an arm and a leg, and you'll get a really good tax refund. I'm using that example on a very far extreme. What you need to be focusing on first, forget about buy old and new, is you focus on the area. And if the area that has all the attractive value for growth or rental income is an older area, that's where you're buying. If the focus area is a much newer area with a new property, well, then you're getting a bit of the benefit, which is the depreciation. So first the area, then the value, and then you look at the best applicable property. And if the best applicable property is a brand new property on a like-for-like value to an old property, I'm buying brand new. Of course, that no doubt about it. But if the older property is far substantially better value than the newer property, has more value, more X factor attached to it, more opportunity, depreciation is just a tax benefit. I want the value increase. That's the real money. People make real money by the property increasing in value or the cash flow, not a tax benefit that comes back.
Not the property growing in value, the land growing in value. The building itself is depreciating. So if you're buying on a 400 square meter lot, you're buying the land. Let's say it's at $500,000. The land is holding, the property is holding most of that value if it's at $500,000. So if you can go buy 800 square meters at $500,000 in a similar area, you're better off with double the land size. So I'll ask you a different question, Jeremy. Of those 1,200 transactions that your clients did, how many of those, I know you probably don't have the numbers down there, how many of those were brand new house and land packages focused on investment?
I don't have that statistic, so I'm going to use my gut when I say this. I'd probably say 99% of those properties were existing. I just don't have many clients buying brand new property because of the education that we've given, or the education that they've learned, that again, they're looking for value, X factor, and generally value and X factor in newer properties. The developer, the builder, and the real estate agents made all that money. They're the one, they've stripped the X factor and the value out in most circumstances, but that's not to say that buying brand new in brand new areas doesn't make money. I've made lots of money by buying in brand new areas and brand new properties, but there were underlying reasons why I did it, because the value of that area was so low to start with, and it only had up to go.
Yeah. But how many deals did you have before you did that, right? Like you were 5, 10, 20 properties deep before you started to optimize on those things.
Absolutely. Yeah. And to put it in perspective for everybody listening, when I'm developing a property and building it and it's brand new, I'm selling it, because that's when the property for me is at its highest sale point.
Like a new car, drive it out and it loses half its value. Maybe not half.
That's it. I'm not waiting 2 years to sell that property because it's not shiny anymore and you're not going to pay overs for it. So When I'm buying property and developing it and building brand new, I'm getting rid of it at the very top as soon as it's completed, because that's where the biggest value for me is being gained.
What about GST?
It's part of developing. It's part of your feasibility and part of the business. It's just what you build in, like business, like we all, small to medium enterprises, Joe and yourself, you're in it. We charge GST to our clients because it's a service. It's mandatory by the government. It's just part of what it is. We don't know any different. So for a property developer, adding GST into their feasibility and tax, it's not new. It's not uncommon. It's what we know, and it's just normal. It comes with the process of doing it.
Yeah. So
we should finish off, Joe.
We should.
This is absolutely the last comment. Well, last.
It's just a comment. A friend of mine bought a house and land package in Clyde, Victoria for $380,000 in 2017 and sold it for $580,000. So that's it. I'm not saying that you can't make money on these things, but if you bought in Queensland for $380,000 and in 2020 you might have made $700,000. So I would be saying, what is the opportunity cost of buying an asset like that? But that you can make money in them. But sorry, you've got me Jeff always cuts me off when I get too passionate about these house and lands. I see too many people get burned.
If anybody's watching and knows a former house and land salesperson, I reckon we need to get not an expose, but I want to sort of understand, like not somebody, that'd be interesting just to sort of unpack some of the tactics So reach out to me. It's okay to DM me this time if you know somebody. I might put a post out there anyway. But there we go. This is a wrap for us in 2023. This is our last live session. We're taking a bit of a break. We're coming back We'll be the 10th of January next year with some new and informative and educational and fun guests. But Jeremy, I want to appreciate you spending close to 2 hours with us. I know you're absolutely family. Yeah, you're probably not at home. So you got to get there. But for everybody, all the people who've been on the lives this year, thank you for watching and thank you for the guests. And I hope everybody has a happy and healthy and safe Christmas and New Year and 2024. But I'll pass it. Good night, preachers.
Love it. Yes.
But
good night, guys. Thank you very much, Jeremy.
Jeremy chance.
How do we
find Jeremy?
How do people learn more about the J-Man?
Yeah, so you're more than welcome to reach out to us on our website, khipartners.com.au. There's a lot of great content, a lot of great videos where I give a lot of great golden nuggets about property investing. So put my name into Google, and no, you do not have to click the link below and charge you 10 grand for those answers. That's part of my passion. I love to give that out for free. And I will plug myself one more time. There is a great podcast coming out very soon on what you should learn at school, where I answer lots of people's questions and go through a huge amount of things that we all should learn financially at school instead of quadratic trinomials.
Wait, sorry? Quadratic trinomials? I didn't learn that. I must have missed that session. Wait, it's a whole new podcast, is it? So it's not through Pizza and Property?
No, whole new podcast. Okay. What you should have learned at school.
What you should have learned at school. What they didn't teach you.
Actually, what you should have been taught at school, I think. Todd's got to kill me for not remembering the name. But it's a great podcast that I go through really financial literacy. Just go through everything that's in my head, everything that I've learned that I apply to every day. And that's what gives me a level of success and I emulate what the very wealthy people are doing, 100 millionaire people, and emulating that so you at home can do exactly the same things.
Get it done. I'll tune in. Episode 1, you'll have me. Love it, Jeremy. Thank you very much, guys. Have a great Christmas. Have a great holiday. Let's go buy a property and we'll see you next year. Have a good one.
See you guys.